In the world of international finance, major institutions rarely make adjustments without a clear, underlying purpose. Observers often note that while surface-level changes can appear routine, they sometimes point to deeper considerations within the bank's operational strategy. Recently, attention has been drawn to Bank of America, one of the largest financial institutions, following a subtle but specific update to its foreign currency exchange systems. This adjustment, which was made without public fanfare or an accompanying press release, has caught the eye of market watchers because it pertains to two specific emerging market currencies, the Iraqi Dinar and the Vietnamese Dong. The quiet nature of this system modification is precisely what has generated discussion, prompting a closer look at what factors could be influencing the bank's internal metrics. The reason this particular update is considered noteworthy by some financial observers stems from its specificity and timing. Banks continuously adjust rates for hundreds of currencies daily to reflect real-time market fluctuations, a process that is entirely standard. However, this specific event involved the simultaneous adjustment of two distinct emerging market currencies, the IQD and the VND. This parallel movement is less common than the routine, independent adjustments. It has led analysts to examine the broader economic contexts of both Iraq and Vietnam, searching for common threads or significant developments that might warrant such a preparatory calibration within a major global bank's foreign exchange framework. The focus is not on the change itself, but on what the change may reflect about the bank's anticipation of future activity. The Iraqi Dinar, denoted as IQD, has long been a subject of intense focus within the financial community. Iraq's economy is underpinned by some of the world's most extensive proven oil reserves, a resource that theoretically provides substantial backing for a national currency. Despite this immense natural wealth, the dinar's value has been suppressed for decades due to prolonged periods of regional conflict, significant political instability, and persistent economic challenges that have hindered its development. These factors have historically kept the currency's valuation at very low levels, making it a closely watched asset as the country attempts to rebuild and stabilize. The recent system update at Bank of America is being viewed through this historical lens, as observers look for connections to the nation's ongoing economic recovery narrative. In recent years, Iraq has been actively working to move beyond its history of instability by implementing a series of significant economic reforms. The Iraqi government has been engaged in a concerted effort to stabilize its national economy, working in close cooperation with major international financial institutions to guide these changes. This process involves a multifaceted approach aimed at modernizing the country's financial architecture and integrating it more effectively with the global system. These reforms are not superficial, they are deep, structural changes intended to build a more resilient and diversified economy. This context is crucial, as any adjustments made by international banks are occurring against this backdrop of deliberate, domestic policy implementation in Iraq, which is aimed at long-term financial health. A core component of Iraq's stabilization strategy involves the comprehensive strengthening of its banking and financial sectors. The reforms underway are designed to tackle several key areas simultaneously. Efforts are being made to improve liquidity throughout the economy, ensuring that capital can move efficiently. Concurrently, the Central Bank of Iraq has been focused on increasing the nation's foreign currency reserves, a standard measure used by central banks to enhance stability and provide a buffer against economic shocks. Furthermore, these steps are widely seen as prerequisites for preparing the country for greater international currency recognition. These are foundational economic actions, and analysts often point to them as necessary groundwork before any currency can achieve a more stable position on the world stage. Vietnam offers a completely different, yet equally compelling, economic narrative. The Vietnamese Dong, or VND, belongs to a nation that has experienced remarkable and steady economic growth over the last 2 decades. Vietnam has successfully transformed itself into a global manufacturing hub, attracting significant foreign investment from multinational corporations. Many companies have been diversifying their supply chains, moving complex operations to Vietnam, which has, in turn, fueled a powerful, export-driven economy. This sustained economic performance has led to a significant increase in the country's overall financial stability and has placed it firmly on the map as one of Asia's most dynamic emerging economies, prompting global financial institutions to continuously re-evaluate its market. Historically, the Vietnamese Dong has also been considered undervalued, largely due to the structure of its developing economy and past capital controls. However, the Vietnamese government is actively pursuing measures to modernize its entire financial system. A major component of this modernization effort is the push to reduce the economy's heavy reliance on cash transactions and aggressively promote the adoption of digital payments and electronic banking. These initiatives are not just about convenience, they are strategic moves designed to enhance transparency, improve monetary policy control, and combat illicit financing. These steps are fundamental to aligning Vietnam's domestic financial framework with established international standards, a process that often necessitates adjustments in how the currency is managed and exchanged. The update within Bank of America's system is seen as a reflection of the institution's response to these profound economic shifts occurring in Vietnam. As the country's economy grows and its financial systems modernize, the way the Dong interacts with the global financial system is expected to evolve. Banks with international operations must adapt to these changes. The adjustments may be part of the bank's internal mechanisms to ensure it is prepared for the changing dynamics of the Vietnamese economy. As Vietnam integrates further into global commerce, the handling of its currency by international banks like Bank of America is a natural area for review and update, ensuring that banking systems accurately reflect the country's progressing economic stature and modernization efforts. What makes this development particularly intriguing to financial commentators is the simultaneous nature of the updates for both the Iraqi Dinar and the Vietnamese Dong. Typically, a bank's foreign exchange desk updates individual currency rates independently, based on the specific market fluctuations or supply and demand dynamics unique to that currency pair. A coordinated or simultaneous update for two different emerging market currencies is considered unusual, though not unprecedented. This specific action has led to speculation that Bank of America may be responding to broader economic signals, anticipated market changes, or perhaps geopolitical developments that could have a linked impact on both regions, rather than just isolated, routine market data. For those who hold or transact in these currencies, it is important to understand the perspective that these changes are not arbitrary. Banks employ rigorous analysis, and adjustments, especially unusual ones, are generally calculated moves. They are often connected to underlying trends that the banking industry anticipates will affect future exchange activity or transaction volumes. This suggests that the institution may be proactively positioning its systems based on internal modeling or analysis of forthcoming developments. It implies a preparatory stance, an alignment of the bank's internal systems with data or trends that its risk analysis departments have identified as significant, even if those trends are not yet public knowledge. The timing of these updates also appears to align closely with significant ongoing developments within Iraq's economy. The nation has been vocal about its plans to diversify its revenue sources, seeking to reduce its heavy dependency on oil exports. This strategy involves a strong focus on rebuilding and expanding national infrastructure, as well as creating new incentives to attract substantial foreign investment. These are not minor policy tweaks but represent a fundamental shift in Iraq's long-term economic planning. The goal is to create a more balanced and sustainable economy, and these efforts are happening concurrently with the banking adjustments being observed externally. In parallel with these diversification efforts, the Central Bank of Iraq has been reportedly active in managing its balance sheet. A key indicator watched by economic analysts is the status of a country's foreign currency reserves. According to reports and analyses, the Central Bank of Iraq has been systematically working to increase these reserves. In traditional economic theory, a central bank strengthens its reserves as a defensive measure to ensure stability, manage inflation, and maintain pegs. It is also widely interpreted by analysts as a foundational step and a necessary prerequisite for any potential change in a currency's valuation or its recognition within the international financial system, as it demonstrates a capacity to defend the currency's value. Economic analysts often emphasize that the combination of actions being undertaken by Iraq is textbook economic stabilization. The strengthening of foreign reserves, the active pursuit of foreign investment, and the comprehensive reforms of the domestic banking system are all prerequisites for boosting a currency's value and credibility. If these positive trends continue, and if the reforms successfully build confidence, it could logically lead to a gradual increase in the demand for the Iraqi dinar for trade and investment. The updated rates seen at a major bank might be an early technical reflection of this anticipated trajectory, as the bank prepares its systems for a different profile of activity. Similarly, Vietnam's own economic trajectory provides an important context for understanding the update to the Dong's rate. The country's gross domestic product, GDP, has been growing at a consistent and impressive rate for many years, largely driven by its booming manufacturing and export sectors. As global supply chains continue to shift and diversify, Vietnam has been a primary beneficiary. Furthermore, the expansion of international trade agreements has further solidified its role in the global economy. This sustained growth directly impacts the demand for the Vietnamese Dong and trade settlements, as more international business is conducted with the nation, requiring the use of its local currency. The modernization of Vietnam's financial system is a critical catalyst in this process. By actively promoting digital finance and making the Dong more accessible and easier to use for complex international transactions, Vietnam is reducing friction in global trade. This makes its currency more versatile and practical for international partners. When banks like Bank of America update their exchange rate systems for the Dong, it indicates that they are likely preparing for potential increased activity and higher transaction volumes. This can be interpreted as a sign of institutional confidence in Vietnam's economic direction, even if a major change in the currency's official valuation is not imminent or confirmed. These specific adjustments must also be viewed within the much broader global financial context. For several years, there has been an ongoing discussion among central banks, finance ministries, and international financial institutions about potential reforms to the international currency system. A significant part of this conversation revolves around the long-standing dominance of the US dollar in international trade and as a global reserve currency. There is a growing interest in exploring alternatives and finding ways to reduce dependencies on a single currency, which could involve a more prominent role for a basket of currencies in the future. This global discussion includes the potential for integrating emerging market currencies more deeply into global financial mechanisms. As economies like Iraq and Vietnam stabilize, modernize, and grow, their national currencies could, in theory, play a larger role in regional or even global trade. Updates by a major, systemically important bank like Bank of America, especially concerning historically undervalued currencies, may be interpreted as a small but significant signal of these larger trends. The bank could be proactively aligning its internal systems with anticipated long-term changes in international finance, preparing for a future where these currencies see greater demand and circulation. In light of these developments, seasoned financial analysts typically suggest monitoring several key indicators in the coming weeks and months. First, close attention is usually paid to any official announcements or publications from the Central Bank of Iraq and the State Bank of Vietnam. These institutions are the primary sources for monetary policy, and they often provide advance signals or detailed roadmaps before implementing any significant changes to their currency regimes. Their official statements provide the most reliable insight into the government's intentions, timelines, and the mechanisms they plan to use for any potential adjustments to their financial systems. A second key indicator that market observers watch closely is the trading volume for these currencies on international markets. While public access to spot trading for currencies like the IQD is limited, institutional markets tell a different story. A sudden or sustained spike in trading activity, particularly if it involves large blocks, is often interpreted as an early sign that institutional investors, hedge funds, or other large financial entities are actively positioning themselves. This smart money movement is closely watched, as these entities often base their decisions on deep analysis and modeling, anticipating potential future movements in currency value well before they become public. Third, analysts advise watching for any new announcements regarding economic policies or major infrastructure projects in both Iraq and Vietnam. These developments are important as they serve as tangible proof of a country's commitment to strengthening its financial system and underlying economy. For Iraq, this could mean new oilfield development contracts or legislation encouraging foreign investment. For Vietnam, it might be new trade deals or milestones in its digital banking infrastructure. Each of these signals can provide insight into how serious the governments are about stabilizing and strengthening their currencies, which in turn informs how international banks will treat them. It is absolutely crucial to stress that these subtle banking updates do not, by themselves, guarantee any sudden or dramatic revaluation. The dynamics of currency markets are extraordinarily complex, often gradual, and require immense international coordination. Even if Iraq or Vietnam were to publicly announce a significant change to their currency's valuation tomorrow, the actual adjustment process would likely be implemented in careful stages. Governments and central banks typically phase in such changes to prevent severe economic disruption, manage inflation, and ensure the stability of their domestic banking systems during the transition. Banks like Bank of America may be preparing their internal systems precisely for such a phased adjustment. It is a common practice for central banks to first adjust rates for institutional or governmental transactions before allowing full public conversion at a new rate. Therefore, the internal rate updates at a commercial bank could be interpreted as a necessary preparatory step. This would allow the bank to update its own books and be ready to handle large-scale institutional conversions efficiently, long before that same rate is ever reflected on a public-facing currency exchange website or at a local bank branch. The potential for the Iraqi Dinar's growth remains a particular point of interest due to the unique combination of Iraq's immense oil wealth and its ongoing, serious reform efforts. While political instability has historically been the primary factor keeping the dinar's value suppressed, the recent economic policies suggest a tangible commitment to achieving long-term stability. The focus on infrastructure projects, new foreign investment incentives, and strengthened banking oversight all contribute to building a healthier and more resilient economic environment for those monitoring the dinar. These domestic developments are the foundation upon which any future strength would be built. Vietnam's situation, while economically different from Iraq's, also shows a promising trajectory according to many economic reports. Vietnam's economy is fundamentally export-driven, and as more international companies establish complex manufacturing operations there, the demand for the Vietnamese Dong for local salaries, supplies, and investments is expected to increase. The financial modernization initiatives, such as building a robust digital payment infrastructure and reducing cash reliance, make the currency more versatile and efficient for modern trade. The Bank of America update may signal that global institutions are preparing for those higher transaction volumes, reflecting confidence in Vietnam's economic direction. In conclusion, Bank of America's quiet, simultaneous update to the Iraqi Dinar and Vietnamese Dong is more than just routine, daily maintenance. According to observers, it appears to reflect the bank's acknowledgement of broader trends in global finance, the significant economic progress within Iraq and Vietnam, and the potential for future demand for these specific currencies. While no immediate, large-scale change is guaranteed or confirmed by the single action, these developments highlight a critical period for anyone monitoring the economic reforms unfolding in both nations. The combination of domestic improvements and efforts toward international financial recognition could create a very different landscape in the years ahead. The key takeaway from this analysis is the importance of staying informed and patient. For those monitoring these currencies, the most reliable strategy is to monitor official announcements from the respective central banks, track verifiable trading activity where possible, and follow the economic developments in both countries closely. Updates like those seen at Bank of America do not confirm sudden changes, but they are signals that major institutions are preparing for potential activity in these emerging market currencies. The next several months could be pivotal as these reforms, international collaborations, and internal bank preparations continue to unfold.